Inflation eased again last month, marking the second straight month of negative surprises in consumer pricing data and driving markets higher. The Consumer Price Index, CPI, increased 7.1% year-on-year and 0.1% month-on-month in November, according to the Bureau of Labor Statistics on Tuesday. Prices increased 6.0% year-on-year and 0.2% monthly on a core basis, which excludes the volatile food and energy components of the report. While Tuesday's CPI number was the lowest since December 2021, inflation remains a drag on household budgets and is more than 3 times higher than the Federal Reserve's long-term target of 2%. Economists and strategists were quick to point out that Federal Reserve officials still have a lot of work to do in terms of slowing increasing prices, and more interest rate hikes are on the way. Following Tuesday's lower figure, we received a flood of Wall Street reactions, which Yahoo Finance has compiled below. Pantheon Macroeconomics chief economist Ian Shepherdson. Over time, the core CPI, which excludes rents and a variety of COVID-sensitive components, tends to track pay rise, which is why Chair Powell and other Fed officials want wage growth to moderate. With wage growth near to 5%, no matter how far margin recompression pushes inflation down over the next year or so, it will not stay down. Most Fed officials appear to prefer wage growth of less than 4%. We believe that is a reasonable goal for the middle of next year, but it will necessitate a minor increase in the unemployment rate and a clear downward move in inflation expectations. More immediately, this news has no bearing on the Fed's decision tomorrow. Seema Shah, Principal Asset Management's chief global strategist. Certainly, with key components such as shelter inflation and core goods inflation declining, it is realistic to expect inflation to fall further in the coming months. Powell, meanwhile, will almost certainly be cautious in his remarks tomorrow. After all, the core services inflation component is inextricably linked to the labor market, which appears to be quite durable across a wide range of data. The difference between 5% inflation and 3% inflation next year is the Fed's capacity to slow the labor market further, which will almost certainly necessitate additional monetary tightening and no rate decreases. Raymond James's chief economist, Eugenio Alemán. The November CPI report demonstrated that this is no longer a one data point doesn't create a trend narrative, and that inflation is now on a definite deflationary path. This deflationary trend is likely to persist in the next quarters, as we expect housing prices, which account for around 1/3 of the weight in the CPI index, to begin dropping. This CPI report will not influence the Federal Reserve's plan to raise the federal funds rate by 50 basis points this week, but it may help prevent the Fed from tightening monetary policy too much. Gargi Chaudhuri, BlackRock's America's head of iShares investment strategy. The factors that continue to drive up inflation are now predominantly inside the CPI's services component, such as rent and housing prices. The service components of the CPI are more sticky. Price increase in services takes longer to decline since it is assumed to represent wage growth and their prices are not modified as much as products. As a result, the transition from 5% to 2% year-over-year inflation will be more difficult than the transition from 9% to 5% inflation. We continue to think that inflation will stay persistently high in 2023, exceeding the Fed's 2% objective. Rick Rieder, BlackRock's chief investment officer for global fixed income. With today's data and what we believe is now a trend toward lower and more normalized inflation readings, the Fed can sit back and let their efforts bear fruit, and bring the prices of those and other goods and service-related items down. At the same time, the Fed will try to keep employment as stable as possible, but it has acknowledged that it may have to sacrifice some employment in the short term in order to bring prices down. Still, if data like today's suggest a real trend of lower inflation momentum, we could see the Fed pause over the next few months at a still restrictive policy rate, but not one that puts potentially excessive pressure on the economy, particularly the interest-sensitive parts of the economy that have already begun to show signs of real, and anticipated, weakness. Morgan Stanley's head of model portfolio construction, Mike Loengart. It's fantastic to see consumer inflation surprise to the downside after PPI came in above forecasts last week. If inflation continues on its current path, the debate over a soft landing will intensify, but keep in mind that inflation remains substantially above the Fed's target rate. The market's early celebration of the news suggests that the reading may provide investors with a sense of relief as the Fed prepares to lower the amount of its rises tomorrow. Bank of America Global Research's chief U.S. economist, Michael Gapin. Overall, the report indicates that core goods inflation is retracing faster than predicted, but services inflation remains sticky. This is unlikely to have an impact on the Fed's December decision. We continue to expect them to rise by 50 basis points, but it may raise the prospect of another downshift in February. Given the tight labor market and rising wage growth, we still believe they will move by 50 basis points, but the argument should be more heated, especially if we get another light December inflation data. Bankrate's senior economic analyst, Mark Hamrick. While inflation is improving, it is still not in a favorable place. The month-to-month variations show that inflationary pressures are easing. However, prices remain historically high when compared to a year ago. Consumers are overjoyed that the price of fuel has reduced dramatically. However, growing prices for other basics, most notably food and housing, continue to squeeze household budgets. FWD-BOND's chief economist Chris Rupke. Inflation is decreasing, allowing Fed officials to decrease the pace of their rate hikes at today's meeting and in 2023. It appears that inflation has hit a tipping point, with price rises dropping or being unchanged for many categories of products and services purchased by consumers. After the run-up last year, consumer prices are barely affordable for many people, but the good news is that future prices will be decreased as a result of the Fed's swift inflation response by front-loading interest rate hikes. Nancy Davis, Quadratic Capital Management's founder and portfolio manager. The market appears to assume that the inflation fight is nearly done, and we do not feel such confidence is merited. We believe that inflation expectations are priced at very favorable levels, with markets pricing in essentially no inflation premium and CPI are remaining several times higher than the Fed's objective. The Fed faces a difficult dynamic in 2023, as the market expects the Fed to end its hiking cycle early in 2023, and the Fed certainly wants to end its hikes early in 2023 before any significant economic damage occurs, but there is a possibility that inflation remains much higher than its 2% target even after it stops raising interest rates. David Russell, TradeStation Group's VP of Market Intelligence. All signals have pointed to decreased inflation, and now we have confirmation. Jerome Powell mentioned a drop in the price of goods, which is now pushing the CPI down. This is a positive indication for the market, but it is unlikely to influence the Fed's stance significantly. They are still concerned about high earnings and rising housing costs. Wages are unlikely to fall, but faster-moving data suggests that shelter is already moderating. According to today's news, we're on the verge of a soft landing. The Fed will keep talking tough and will most likely increase the dot plot tomorrow. However, inflation appears to have peaked. Nikko Asset Management's chief global strategist, John Vale. The data show a peculiar paradox, with commodity and shipping prices falling significantly while many other prices rise. Because many prices rose so quickly, particularly house prices and rent, prices remain high compared to 2 years ago. This is also true for money supply indicators and other macro data, implying that there is still a lot of pent-up inflation in the system despite many prices falling since their peak. This is why labor is striking, as they have received few wage increases in the past to balance previous inflation. The role of labor unrest in 2023, our large wage increases to avoid it, will undoubtedly be an important factor for the Fed. Bolvin Wealth Management Group President Gina Bolvin. While this is the second consecutive month of lower than expected inflation, we don't believe it will change anything at the Fed meeting tomorrow. We still predict a 50 basis point increase, but what matters is direction. Powell now faces difficult decisions, and the Fed faces a difficult task in balancing inflationary pressures with a tight labor market. While today's data indicate a positive trend, investors should not overreact. The last time the market gained in response to weaker inflation data, we had the Jackson Hole jolt, in which Powell pushed back and reiterated rises. Because markets are pricing in rate reduction, guidance is critical.